Now I know there's been some pain in the market lately. Well, how about I butter you up and sweeten your day with 38% off my stock program on how not to be a sissy paper hander and show you how daddy takes on the real bacon. Check out the link below and use coupon code HODL.
And yes, take advantage of that coupon code before it expires. But now let's talk about a potential mortgage and housing crisis, because many people have been asking me for an update on this because, well, that's what I do. Half of my net worth is in real estate. I got my start as a real estate agent, then real estate investor, then real estate broker, and then real estate investor. It has been a blast. I'll tell you, there's nothing as simple as swiping up on Robinhood or maybe Webull and making some trades. But real estate has always been a big part of building wealth for me, and a big suggestion for you to build wealth with, because after all, if your net worth is under $500,000, you can generally make some big returns in real estate, taking advantage of the amazing institutions that exist in America. But we got plenty of videos on that. Right now, we got to focus on, is there going to be a housing crisis and a mortgage crisis coming up? First, after all, we know that tenants have not been able to be evicted for over a year now. And Biden has extended mortgage forbearance and these eviction protections through June of 2021. At the same time, mortgage rates have been ticking up slowly, but they've been at record lows. And so together, we've seen fewer sales hitting the market and lower interest rates, which basically has been leading to a frenzy in the real estate market. In December 2019 to December 2020, we've seen real estate prices skyrocket 13%. Which for those of us in stocks, it's like 13%. But remember, that is a highly leveraged 13% usually in real estate, so you can see some real outsized gains in real estate. But again, this video is about the market and not on the fundamentals or the principles of real estate. Unfortunately, things have been changing a little bit lately. We have seen the 10-year Treasury yields go up. And guess what happens to track the 10-year Treasury yields very closely? Mortgage rates. And guess what also happens when the 10-year Treasury spikes and we get a rapid acceleration in the 10-year Treasury yields? Well, tech stocks sell off. And so what does that mean for Kevin? Well, that means higher mortgage rates and all of his stocks sell off because they're all freaking tech. Most of them are. But yeah, I mean, these are real issues, right? When rates go up, real estate becomes more expensive, and in the short term, stocks can sell off. But not only are we potentially concerned about rates going up, but we're also thinking, hey, as the markets open back up again, more housing inventory should hit the market because people won't be as fearful of COVID. Hey, come on in my house, look in my house, let's have an open house again, whatever. And maybe we'll see more properties hitting the market as our economy reopens, at the same time as maybe rates will be higher, at the same time as eviction protections will expire, at the same time as mortgage forbearance expires. When we line it up like that, it sounds like we could have a pretty damn nasty turn near mortgage crisis and real estate meltdown. I mean, think about it. More inventory hitting the market because of the opening. Higher potential interest rates means borrowing costs go up, which means prices go down. And if prices go down at the same time as there's more inventory on the market, which accelerates the decline in prices, at the same time as eviction protections expire, which might mean more landlords end up putting those properties on the market for sale. Some of them obviously will rent. Some of them will decide to sell those properties, which means even more inventory. And mortgage forbearance ends, which means people who don't comply could potentially get foreclosed on because now foreclosures become an option again for banks. Whew. We could see one heck of a brewski storm in the real estate market. So let's try to break this apart a little bit and understand, okay, what kind of resilience do we have? What are the real risk factors here? And what do we think is actually going to happen? All right. So to quantify this, the first thing we need to do is we need to understand the classic rule that I regularly teach in all of my programs on building your wealth, which, yes, that coupon code does expire. So take a look at that, linked down below. But the programs generally teach, and I teach this on the channel too, this portion, this matters. When interest rates go up 1%, real estate purchasing power goes down 10%. So you have what I call the rule of 10x. A 0.5% increase in mortgage rate, a 5% decline in real estate prices. And it's almost instantaneous. So lately, a lot of people have been wondering, hey, Kevin, why has real estate gotten so expensive? Well, because interest rates have fallen like 1.3, 1.4%. Imagine that. Real estate prices went up 13% over the year. it almost always lines up to what's going on with the interest rates. Now, sometimes we do have an acceleration of appreciation above and beyond what the actual interest rates are. But right now, housing prices seem largely driven by low interest rates, which is obviously leading to a lack of inventory as sellers adjust to those higher prices because the prices are like, it takes a while for the market to realize, oh, we can get that. Oh, we could get that. And it's usually because home prices aren't actually dictated by the free market, which would be whatever somebody's willing to pay. And while it seems like they would be, kind of are, but they're also restricted, they're anchored by appraisals. When appraisals come in low, people can't actually get loans and use those mortgage rates. So oftentimes you actually need appraisers to be comfortable with the fact that prices are going up to start appraising properties higher to actually allow prices to rise. So sometimes real estate prices going up can be a little slower. Whereas ironically and classically, when prices are going down, appraisers are more than willing to appraise you for less. That's funny how it works. And that's not a slam on appraisers. It's a slam on risk, right? It makes sense. You want to be more risk adverse when prices are going up, and you want to be more conservative potentially if real estate prices are falling. Anyway, so we know that home prices have gone up 13% year over year. And we know that home purchasing power is highly, highly correlated with interest rates. And we've got some really bad potential things coming where we could see a lot more inventory and a lot more pain coming to the real estate market. All right, so how resilient are we? Well, I'd like to refer first to our first piece of evidence, okay? This here is from the Wall Street Journal. Borrowers cash out on homes. When I first read this, I got a little nervous because, as they say in the article from the Wall Street Journal, cash out refinances got a bad rap after they exploded. In the run-up to the 2008 financial crisis, borrowers tapped their homes like they were ATMs. When home prices plunged, they were left owning more than their homes were worth. Now, in 2021, many economists expect home prices to keep growing. Okay, now that's not exactly the line that I was expecting, but wait a minute, this is interesting. This article is actually also saying that US homeowners cashed out $152.7 billion in home equity last year, a 42% increase from 2019. Wait a minute, so you got economists saying, okay, maybe home prices will keep going up, and interest rates are at record lows, and people refinanced 42% more in aggregate than in 2019? That's a lot of refinancing, and that's the same kind of refinancing boom that happened before the 2008 real estate crisis. I mean, many would argue real estate-induced Great Recession. That's scary. In fact, they say here, lenders churned out more mortgages than ever in 2020, fueled by about $2.8 trillion in refinances, according to data from the firm Black Knight. Some borrowers viewed cash-out refinances as a way to cushion themselves against an uncertain economy last year. Yeah, I did do that. Others wanted to build and redecorate. Ooh, big mistake. Big no. But anyway, this sounds a little concerning, especially since they say low rates, the average rate on the 30-year fixed rate mortgage being below 3% led more people to refinance. So look, I'm all for people lowering their payment when you refinance, but the danger is when people basically break the piggy bank of their properties as prices keep going up and they take more and more cash out of their properties, and basically what they're doing is they're creating more and more debt, they're ballooning their liability, and in the event that prices fall, we have an oopsie doopsie poopsie scoopsie DD, and that would be really bad. So how do we put this together? Like, how could we quantify, like, how bad could the crisis get if people are pulling out debt like crazy? And then we've got all of these catalysts for potentially more inventory and more listings coming up on the market at the same time as maybe we'll see higher rates. Well, take a look at this. CoreLogic put together this awesome report, which they do monthly, and this is called their LTV and homeowner equity report. And so loan to value is what LTV stands for, and it basically says, hey, how much equity do people have in their homes? In other words, how much net worth is in their homes? If you have a $100,000 house and you've got $70,000 of debt, you have 30% equity and you have a loan to value of 70%. 70% debt, 30% equity. So the higher number, the more risky, obviously. And if we look at the chart here in Q4 2020, this is going to be kind of the green chart here. I'm going to hide myself for a second. You're going to see that there are actually some people who are underwater. They owe over 125% of what their property is worth. It's a little less. In fact, all of these green bars are a little bit less than the gray bars, which does mean that people have become less underwater as time is going on, which is normal when prices are increasing. It's obviously bad when prices are decreasing. But if we just grab all of these right here, people who are basically over 90% leveraged, we get about 8% of all homeowners that are this leveraged. That's because this line here is about 1%, and you could add up the math. If we go out to about 20%, we'll be able to add these two new bars right here, which is going to give us somewhere around 6% more people. That means 14% would be underwater if prices fell for 20%, excuse me. And if we go out to 30%, so if prices fell 30%, we'd be able to grab these bars over here as well. We'd be adding about 7%, and let's round up and say 6% here, so another 13%. That would mean 27% of people would be underwater. So this chart is basically telling us that if prices fall 10%, so a decrease of 10% in prices, we'd have about 8% of people underwater. And that includes the people who are already underwater. Then we would have about, if prices fell 20%, we'd have about 14% of people underwater. And if prices fell 30%, we'd have about 27% of all homeowners underwater. So this actually now sets up a very interesting scenario, because if mortgage rates go from 3% to what they were before the pandemic, around 4% or the high 3s, and remember lately we've also been able to get rates in the low 2s, which has created some of this pricing pressure because people have been getting rates so cheaply. If we see rates go from 3 to 4%, that's a 1% increase. And what does a 1% increase correspond to? Boom, 10% decrease in property values. So simply by interest rates going from 3 to 4%, we could see 8% of houses underwater in total. That would be a problem. And that's from where we are now, where I would say under, let's see, that's 2% plus a fraction, under like 2.5% of people are underwater. So we could see like a 3xing of the people underwater just from interest rates going from 3 to 4% and then seeing prices come down. By the way, quick note, I know that the real estate market is super competitive right now, and one of the things that I'm doing to find listings off market is I'm sending, and I know this sounds old school, but postcards with Deal Machine. Go to metkevin.com/deals and check out Deal Machine. It's a pretty amazing way where I could just go on my phone and click on all the multifamily buildings or vacant buildings in my area and actually reach out to them before they potentially hit the market. And that's what I want to do. So check out metkevin.com/deals. But here's a little problem that we have to talk about. If interest rates go from 3 to 4% and prices fall 10%, but inventory is still too low to support demand, then the prices will actually be propped up by the lack of inventory, and maybe we actually don't see prices fall. Maybe prices won't go up 13% again, but maybe it just offsets the fact that property values would be falling because there's so little inventory, and that props up demand, even as interest rates go up and properties get more expensive. Something to consider. Now, let's go back here to the chart, because we've got some potential issues here. So in addition to interest rates going up, what if Biden lets the eviction moratorium lapse and the foreclosure moratorium lapse, and we get a hot summer selling season where we got a lot of sellers starting to dump properties? What happens if those three things mix together? Well, then it wouldn't shock me for us, first of all, to eliminate the inventory shortage, which means we'll actually realize that 10% decline. But then we could potentially also start that slippery slope of prices declining more. And it's entirely possible that if we saw at the same time as a foreclosure crisis, which we don't expect there to be a massive foreclosure crisis, especially since mortgage forbearance programs are really designed to keep people in their homes. We're not expecting there to be a lot of foreclosures, but there will be some. In addition to evictions, we could start trending up to that 20% decline region, or 20% decline in property values region. That would put around 14% of people underwater, but this cohort right here wouldn't be heavily underwater. Sure, if you consider selling costs, yeah, they'd be underwater. But they might not be forced to sell. So this is where let's take a step back from this crazy chart that we've drawn, and let's put some thoughts together here. So let's jump on over. So what do we got so far? We have a concern. We have a few concerns. The first concern we have is interest rates going up. It's a problem. It could create issues. The second compounding concern that really needs to happen to see a mortgage crash or a real estate crash or a mortgage crisis is seeing inventory go up. If we see those two things happen at the same time and inventory go to the point of saturation to where there aren't enough buyers to absorb all that because interest rates are going up at the same time, right? Those two interplay. If we see that, yeah, it wouldn't surprise me that at the bare minimum, prices will stabilize and we won't see the increase. So bare minimum, prices stabilize. If we see rates go to 4%, prices stabilize. The next scenario, so let's call that the base case scenario, is interest rates go to 4%, prices stabilize. If interest rates stabilize and inventory floods the market, a la evictions, foreclosures, or summer and people want to sell and COVID's over and people are dumping their homes because they want to move, now we could get to that territory of that 10 to 20% decline, and that could potentially self-fulfill a little bit. This would create a little bit of an issue. And now we want to figure out, okay, how insecure are people who are actually doing the refinances and the purchases right now? Because that's going to help us understand if we have a 10 to 20% shock, how resilient are the people who are doing the refinances? How resilient are the people who are buying homes right now? And this is where we can actually go back to that original Wall Street article, because this is pretty fascinating. I'm going to ask you what you think the conclusion is here. But there's a chart on here, and it says mortgage originations by credit score quarterly. And what I want you to guess is which credit score you think had the most refinances or mortgage originations. We'll lump both of them together. Which credit score had the most in 2020? So, and we'll have this charted, so we'll get to see the difference between prior years and 2020. So, do you think that people with under a 620 score, under a 620 credit score, had the most originations? Or did they have the biggest spike? Do we think that people between 620 and 659 had the biggest spike? How about 660 to 719? 720 to 759? Or the people over 760? Which group do you think had the largest spike in mortgage originations? And this is very important because remember, a higher credit score implies more financial stability. Not always, but remember, credit score is a measure of risk for banks. They use your income, they use how quickly you pay off your loans, how much other debt you have outstanding relative to your income. These are your history of paying later on time. These are all tools to determine risk. So the higher your score, the less risky of a borrower you are, and presumably the more resilient you are. So in other words, worst case scenario, the people doing the refinances are people like what we saw in 2008, where everybody was taking cash out. Somewhere in 2008, the people, like anybody doing refinances in 2006, 7, 90% of those people were taking cash out of their homes to like use their homes as a piggy bank. And people were using ARM adjustable rate mortgages to basically expose themselves to variable interest rates rather than fixed interest rates. And at the same time, people were getting loans that they actually had no ability to repay, right? Things were pretty dang nasty in 2005 to 2008 with the people who could get loans. Not very quality loans, right? Lower credit scores, some cases no jobs, the ninja loans, no income, no job, no assets. If we saw that again, we would expect that people with probably what? 620, 640, 660, 680. We would expect those groups to be skyrocketing in mortgage originations because, hey, why not? Everybody's getting rich off real estate, so why not plow in? Money's cheap. It must be easy to get a home loan. And keep in mind, when we look at this chart too, it also lets us know how tough lenders are. Like if one group, let's say like the 620 group is skyrocketing and everybody else is just growing at an average pace, that's a sign that lenders are loosening their criteria, right? That lenders are being more looser and they're like, we just want to lend. Like, let us just give you money, please. We want to make more money in fees. Let's just get more people in, even if they're low quality. And I'm not saying low quality people. I mean, lower quality in terms of higher risk. Lower quality loans is the proper way to say it. I'm not judging people's character. It's lower quality loans versus higher quality loans. So again, if we see a spike in that 600s range, that's a concern, because then we have a potential for a perfect storm. We have lower quality loans going into a potential higher interest rate environment, which will drive prices down via the rule of 10x, which could compound with the end of the foreclosure moratorium, the eviction moratorium, and the fact that COVID is opening up, or like the economy is opening up again, people want to put their homes on the market. Then you got some real poopy doopy happening. That would not be good. I could see a 10 to 20% decline compounding pretty quickly in that kind of event. But what if the opposite were true? What if the people getting loans were actually the most highly qualified individuals? Well then, even if prices fell 10% or even 20%, those individuals might not be forced into a situation where they have to sell because all of a sudden their interest rate went up. Maybe they still have equity or some equity, or they have no motivation to sell because they make enough money at their jobs to support their bills, which probably means they have a higher credit score. So higher credit score individuals probably going to be more likely to maintain their property. And this is all probability, right? We're not trying to say somebody with like a 620 is guaranteed to go into foreclosure where somebody with an 800 is not. But generally, when we look at risk scores, this is a tool we like to compare. Okay, well, let's get the actual facts. So, we've got a lot of insight so far. It's a lot of detail in this video. Let's take a pause here, take a quick little breather, take advantage of the fact that you can get 38% off on that coupon code or via that coupon code for those courses down below, including my course on do-it-yourself property management, rental renovations, real estate investing, making YouTube videos, stocks, and the psychology of money. Take a little swig of some Topo Chico. Let's hit the numbers. This Wall Street Journal article tells us that the borrowers who cash out refinanced in 2008 made up 90% of borrowers. So remember, 90% of people in 2008 were taking cash out. Today, or in 2020, 1/3 of refinancers chose the cash out option. 1/3. So around 33%. That's actually a really good sign. So it means people who are refinancing aren't necessarily taking a ton of cash out of their homes like a piggy bank. They're actually just lowering their monthly payment, and well, that's a good thing because that creates less risk. Okay, so that's good. All right, well, what about what kind of loans they're getting? Well, it says here that the average loan that people are getting is a loan at a cost of under 3% fixed for 30 years. And that's in contrast to 2008 when people were getting variable rate loans, which were potentially due and payable in 2 years, or the interest rate was going to go up after 6 months because they had these introductory 6-month teaser rates. That stuff doesn't exist anymore. It's totally illegal. Like, people have to prove they have the ability to repay, and you can't have these crazy adjustments in payments. Those 6-month teaser rates are gone, in other words. Okay, that's good. But what about the credit score? The median credit score of new refis last year approached 800, near the top of the scoring range, according to the Federal Reserve Bank of New York. That includes refinances in which the borrower didn't even take cash out. Well, that's a good thing. So what do we have? All right, well, we have a need for some more data. And then we're gonna draw some conclusions. I'm telling you, this is a data-rich video, and it's very, very important. Folks, what's actually happening in the market right now? Let's take a look. Let's jump on over to the iPad here. See exactly what's going on. This is Redfin's chart of inventory available through December of 2020. Through December of 2020, we are at the lowest levels of inventory we've pretty much ever been in the last decade. So we have ample capacity for inventory to go up, and we'll still not even be at the levels where we previously were. On top of that, since that chart ends in December, Redfin is so generous to provide weekly inventory data for us. And they do indicate a nice increase in inventory here from January going into February. This is good. However, comparing this January and February to 2020's January and February, inventory this year is still down about 20%. So the new listings hitting the market, right now at least, are still 20% fewer than they were last year. So how do we put this data together? Because this is a crap ton of data. Well, here's the way to look at it. Right now, the real estate market seems insanely resilient. The people who are buying homes have equity. The people who have homes are not taking cash out at 2008 levels, and they're getting quality loans, and they're reducing their monthly payment burden when interest rates fall. And they're getting 30-year fixed rate loans. On top of that, while we expect there would be risks if interest rates go up and we have low quality borrowers or low quality loans, which we don't have, sure, interest rates going up is still going to be a potential risk, but it only gets compounded. It only becomes a problem when inventory starts skyrocketing. And so far, year over year, inventory is still declining relative to last year. And on top of that, just look at the magnitude of the chart. The people who are doing all the mortgages right now are the really, really well-qualified people, the ones with the highest credit scores. The top-tier borrowers are the ones getting loans. Lauren had this to say: refinancing is a good financial decision, and certainly was a good financial decision in 2020. And people with great credit scores tend to make good financial decisions. So this totally makes sense. These align. And Lauren's not wrong. I'm talking about Lauren, my wife, not any other Lauren. So when it comes to assessing, will there be a 2021 mortgage crisis or housing crisis, we have to look at the data. Yeah, there are anecdotes like me saying, oh my gosh, what if the mortgage crisis, what if the mortgage forbearance programs end? What if foreclosures come? What if evictions come? There are these anecdotes that people are refinancing like crazy. All of these things, and we hear these anecdotes that inflation is coming and that rates are going up sooner than we expect. When we put these anecdotes together, guess what we get? A really good market crash video on that's it, real estate's going down. But when we actually peel back the layer and we're like, wait a minute, are we actually gonna have inflation? Well, I've got dozens of videos on this. In fact, if you wanna watch my most recent one on this, type into YouTube, Meet Kevin, the coming Great Depression versus Roaring 20s. Talk all about it there. So we might not see inflation coming. We certainly aren't seeing low quality borrowers. We're seeing the most able to afford borrowers get loans. We're not even seeing them cash out refinance as much as they were in 2008. Instead, they're just lowering their payments and they're taking 30-year fixed rate loans. And on top of that, Biden's in office, who's probably just gonna wave his pen and go, yo, mortgage crisis? Hell no, not on my watch. And he's just gonna extend the mortgage forbearance programs if necessary. This isn't even to mention the fact that over the last 2 stimulus packages, we've gotten over $50 billion in rental aid for people who are back on rent payments, back on utility payments, back on housing payments. If they're landlords, you can apply for homeowner assistance, utility assistance, rental assistance. Like right now, looking at the real estate market and the actual data, especially with inventory numbers still falling, it seems incredibly robust. Now, that does not mean immune. What would it actually take to crash the real estate market? Honestly, probably a 2+% increase in interest rates. I don't see that even remotely happening until 2024 or 2025. And then we'll have to have a conversation. And I'm sure we'll have another conversation between now and then. But just what we're seeing right now, a lot of it is just anecdotes. And the more you peel back the layers, the more you're like, no, I don't see a real estate crash coming here anytime soon. Anyway, folks, if there was a real estate market crash, we all know we would buy the dip because you're part of the amazing courses, which you can get via the link down below and get 38% off on using that coupon code. Anyway, folks, thank you very much for watching. If you found this helpful, consider sharing the video. And folks, we'll see you in the next one.